The Fed's usual move in a weak economy is cutting the federal funds rate. Cheaper borrowing, more spending. But zero is the floor. The Fed has never cut below it. So when the rate is at zero and the economy still needs help, the Fed is out of cuts. That's when it reaches for a second tool. Remember, lenders set the 10-year Treasury yield by deciding what return they'll accept. Quantitative easing is the Fed becoming one of those lenders, an enormous one. The Fed buys Treasuries and mortgage-backed securities, bundles of home loans sold as investments, in bulk. Massive new demand for bonds pushes bond prices up and yields down. Lower yields mean cheaper mortgages and cheaper business loans. Where does the money come from? The Fed creates it. Banks keep accounts at the Fed and it simply adds to their balances electronically. No printing press. Those reserves stay in the banking system, which is why this isn't the same as handing out cash. Quantitative tightening is the reverse. The Fed stops replacing bonds as they mature, letting them roll off. Less demand for bonds and yields drift up. How big does this get? The Fed's balance sheet went from under $1 trillion before 2008 to nearly $9 trillion by 2022. That scale is why quantitative easing is controversial. Critics argue it inflates asset prices. Lower yields make bonds less attractive, so money moves into stocks and real estate instead, pushing those prices up. That mostly benefits people who already own assets. And economists still disagree about how much quantitative easing contributed to the inflation that followed the pandemic versus government spending and supply chain shocks. What's not in dispute? There have been 4 major quantitative easing programs since 2008. This isn't emergency only anymore, it's a standard tool. And that's exactly what worries the critics.